I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. Welcome back to the show, Drew.
Thanks for having me on again this week, Jim.
Drew, the Fed Reserve dropped interest rates yesterday by 25 basis points, the first reduction in 11 years. Why did they do it, and what was the impact on the markets?
Yeah, I mean, there's a lot of argument going on right now about why they did it. Should they have done it? Did they do not enough? I think when you look at their reason for doing it, it goes back to expectations of the market. So whether or not you're a believer of this, I believe it to some degree. I mean, the market had fully priced in an interest rate cut. If they weren't going to cut rates, there would have been a big tantrum in the market, much more than we saw yesterday in yesterday's sell-off. But at the same time, I think the Fed is also seeing a lot of global indicators, whether that's manufacturing PMIs around the world, the trade tensions, especially with China, continuing to be a drag on the economy. They will point to their inflation target being, or their inflation level being below their target. So they had room to do what I am viewing as more of a insurance cut. Powell called it a mid-cycle cut or mid-cycle adjustment. So the reason for doing it was, things are slowing a little bit. Let's give ourselves a little bit of breathing room, and hopefully things will, turn around and be okay. And if that's the case, no harm, no foul, and we can raise rates later. And Powell did actually make that comment in the press conference. And then at the same time, if things were to get worse, hey, we can say that we were starting to get in front of it, and we're ready to make moves as the data comes in. So for them, I think it was a largely, easy call to make, given that it was priced into the market, and the fact that, they could say they were getting in front of any softness out there, while at the same time, a 25 basis point cut, does that really change anything on a broad spectrum? And I think more importantly than the 25 basis point cut was, Powell's forward guidance for what the markets should be expecting going forward.
The Bank of England today announced it was keeping its rate the same at 0.75%. Should they move downwards, or are they just going to hold there for a while longer?
The Bank of England is in a tricky situation as well. I mean, maybe never a good time to be a central banker, but Mark Carney can definitely be caught in between a bit of a rock and a hard place right now, where some of their economic data is staying strong. Inflation pressures are higher there than they are in the U.S., above some of their target levels. So, there's rationale to say maybe they should be raising rates. However, the big elephant in the room with the Bank of England will be Brexit, and whether they get a smooth exit from Brexit, or whether it's sort of just a hard Brexit, which then causes who knows what kind of economic disruption. So they're definitely not going to do anything before that October 31st deadline, in which the new Prime Minister, Boris Johnson, has said, there will be a Brexit by then, just depends which type. So for them, there's no hurry to try and act in front of that. The other side of it is, currencies and can be a judge of some of the economies. So if you've got all the other central banks in the world easing or on a path to easing, I mean, you've got the ECB saying they're going to cut at their next meeting. You've got the Bank of Japan has basically continued on its easing for a long period of time. You've had the Australian Central Bank, you've had Brazil cut rates, you've had South Korea cut rates. So if you really want to go the other way, I think that could be exacerbated in your currency really going much higher. Now, at the same time, you can say, well, maybe that's not a bad thing. The British pound is at an incredibly low level and has moved a lot lower recently. But again, that ties into them not moving with their overnight rate because of the Brexit uncertainty that's there. So I think for them, they've got sort of the best reason out there to stand pat. One, in their economic data and the measures that they follow say that they should be possibly raising rates. However, given what's going on in the global economy and their Brexit scenario, that's the perfect cover to say, hey, we're willing to just stand pat and stay ready to act if necessary.
We'll have more with Drew Zimmerman right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, the latest move from yesterday seems to be in currencies with the U.S. dollar at a 2-year high. Do you see further U.S. dollar strength?
Yeah, the U.S. dollar has been definitely strengthening over the last couple of months, and then broke out, decisively, I think, yesterday, and has largely held that move. So a lot of the initial reaction that we saw from the Fed rate cut has been backtracked. Like stocks, for example, are back to levels they were before the Fed meeting yesterday, where the U.S. dollar is largely held on to a lot of its gains, and as I say, out at 2-year highs. I do think that we can see more U.S. dollar strength ahead on a couple of fronts. One is I think we saw some of that U.S. dollar strength not because the Fed cut 25 basis points, which on its own you would think should weaken the currency, but again, because I think of where markets' expectations of what the Fed was going to do. There was still some thought we get 50 basis points at that meeting, but then more important, where the market had been pricing in the Fed for the rest of the year. So the market had been pricing in a Fed that was ready to open the door to an easing program that would go on for who knows long. And I think Powell sort of stood against that yesterday and said, this is a mid-cycle adjustment, kind of entailing that maybe there's 1, 2, maybe 3 rate cuts, and that might be it, but they would be data dependent. It's not the start of an easing cycle in his mind, given what he sees. So again, it's always about what you get versus expectation. So I think that fact that he was a little bit more hawkish gave the U.S. dollar some strength there. And I think given that the other central banks do seem, outside of the Bank of England, as we just discussed, do seem to be on more of an open easing path. So you do see that central bank divergence there. The other thing that we're seeing just on an outright basis, let alone the divergence, is the negative rates that are spreading throughout Europe, especially as the ECB has signaled that it is opening that door to further easing that maybe doesn't have a limit on it. So you're seeing the U.S. 10-year right now, even though we're trading down, at 1.95%. Well, the German 10-year is at negative 0.545%, a new low on that sort of move. So you're getting almost an extra 2.5% and you're actually getting money back for lending your money to the government than having the government take money for holding your money. So I think there's still, as much as there's a divergence in the policy, there's still going to be flows into the U.S. dollar just because of the absolute amount. If you can get money back for giving somebody your money rather than get less money back, I think you're going to take that. So I think that's where you see continued flows into the U.S. That's where you may see continued flows into the U.S. bond market to get those rates, which then I think continues to drive U.S. rates lower. And even though that divergence or the difference in rates could be closing, it still, in absolute terms, makes so much more sense to be getting a return on your investment than to be paying. So even though those differences could be narrowing, I think there's still going to be flows into the U.S. for that. And we still see a huge outperformance in U.S. equities as well. So as money flows into the U.S. to get this higher rate, you can also see some of the money go into U.S. equities. As that happens, U.S. equities could continue to outperform. And if you're leaving that unhedged, if you're an international player, you can be getting some U.S. dollar outperformance as well. So it's sort of a self-fulfilling cycle that can happen where you can see the U.S. dollar continue to strengthen. And again, I think that can sort of feed on itself as people come for higher rates than what we're seeing in Europe. And we just don't know how far it's going to go in Europe. I mean, we've now seen high yield companies in Europe issuing negative yielding debt. I mean, that is a true oxymoron if I've ever seen one, where a high yield company is issuing negative yield. It's just hard to wrap your head around and hard to think that this isn't some sort of debt bubble. And where it's gone the furthest is not in the United States. I mean, even again, just another example, we've got Greek 10-year at almost the same level as U.S. 10-year. I mean, this was Greece that was about to, implode only 5 or 6 years ago during the sort of the crisis that was going on in Europe with the amount of debt that they had. So I think it's a phenomenon to watch, but again, I think that can see the U.S. dollar continue to get bid.
We'll have more with Drew Zimmerman right after this.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, given how important the U.S. dollar is for so many markets, what's your view on its value going up? What's it going to have? What kind of impact?
Yeah, absolutely. So much of what we see in the world, the commodity markets especially, are all priced in U.S. dollars. So anytime you have the denominator of that equation rising rapidly, it always exerts downward pressure on whatever commodity or entity that might be. So I think you can see some continued pressure on the commodity space, again, just as the U.S. dollar rises and every commodity that's priced in U.S. dollars. And also, again, just going back to the debt scenario out there, I mean, we're seeing an incredible amount of global debt. Yes, corporate debt in the U.S. is high, but we're also seeing, other nations, other big foreign multinational companies that have U.S. dollar debt. And if you're a U.S.-based company with most of your revenue in U.S. dollars, that's not a problem. If you're raising all your revenue is in other currencies and you have a rising U.S. dollar, your debt load, even though interest rates might be staying steady or coming down, again, credit spreads would be a different discussion, but all else held equal, a rising U.S. dollar makes your debt payments that much bigger if you're coming from another currency. So another area of the market that I'm watching is the emerging market currency or currency basket, the emerging market equity baskets that we can see. And I think that can be another level of risk if you see especially a sharp move in the U.S. dollar. So if we hold above 98 on the U.S. dollar index, which we've moved up firmly through, if we continue to move towards par or the previous highs of the 103, 104 area, that could be a fairly sharp move that could cause some stresses as all these other entities or other sovereigns all of a sudden have a much higher debt load than they had before, especially given that we're seeing a slowdown. Right now, it seems mostly tied to the manufacturing sector, and a lot of that due to trade as well. But again, it's going to be some of these emerging market companies that rely a lot on the manufacturing side of things. So if we see manufacturing PMIs continue to slow as they have, there could really be a significant risk of a rising U.S. dollar that these countries could face.
Does the U.S. dollar strength mean the big run on gold has a chance of stalling and maybe going down?
Yeah, the U.S. dollar is an important component of gold. I mean, gold is, as we talk about it, is always priced in U.S. dollars. So there's that denominator component that I talked about. However, there's also a few other factors that I'm looking at in gold right now. The other big factor to always keep an eye on, in my mind, is the real interest rate market. As real rates go lower, I think there's more incentive for people to hold gold because you're getting less return on bonds, and gold has never paid a coupon or a dividend payment and never will. So as real rates move, that's going to have an impact on gold. So this run-up that we've seen in gold has been, I would say it's been capped with some of the U.S. dollar strength that we've seen over the last month, and that's where you've seen gold has consolidated. What's been impressive with the move in gold is that after such a sharp run-up, it has largely just consolidated in price. It hasn't had a sizable pullback. And that can be because I think we are seeing help in the gold price from real rates continuing to move lower, especially here again today. We've got rates moving back down, and if anything, I think inflation expectations are staying steady and or maybe even moving higher with the Fed easing, which should be a benefit for gold. And I think in the medium term could be a big benefit for gold. However, I do think that if we were to see a sharp move in gold or in the U.S. dollar, that could apply a little bit more pressure to the gold market, downward pressure. And then the part that worries me more is the positioning risk that is in gold. It really caught the eye of investors. I mean, gold had been sort of the shunned market for quite some time. It caught the eye of investors. More and more investors piled in. The speculative positioning in the COT data for the futures market shows the positioning, net positioning, at the highest level that we've seen ever. This is the second time it's been up at these levels. It's been several years since we've been here. So when you have that many speculators all sort of pile into a market, and especially some of the longs that have come in over this past month of consolidation, any breakdown to new lows or a breakdown of this consolidation level can see a lot of those late buyers maybe throw in the towel on their longs as they start to realize some losses. So I'm a little worried about the positioning size of gold still. But if that were to moderate through this consolidation period and gold held above 1,400, I think this U.S. dollar strength, even if the U.S. dollar were to stay at higher levels, then I think you can still see real yields and possibly, the need for risk-averse holdings if equities were to falter at all really help the gold prices as well. So I'm cautious at these levels with gold that a possible sell-off could occur. I think that sell-off would be, what the positioning market sort of needs, and that would be sort of your entry opportunity for what I think is looking like a great setup for the medium to long term for gold prices.
Drew, thank you so much for speaking with us.
Thanks for having me on, Jim. Appreciate it.
My guest has been Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His website's pifinancial.com and polarfuturesgroup.com. If you have any questions for Drew or any of our other guests, you can send them to info@howstreet.com. You can find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.